In 1997, Korea plunged into a financial meltdown. The IMF bailout became inevitable, the won collapsed past 2,000 per dollar, and unemployment soared as companies went bankrupt overnight. That crisis is still remembered as one of the darkest chapters in modern economic history. So in 2025, could emerging markets be facing a similar fate? To answer that, we need to look at what has changed and what hasn't. First, foreign reserves. In 1997, Korea held only about $20 billion, barely enough to survive a few days. Today, reserves exceed $400 billion, among the largest in the world. This provides a much stronger shield, though history reminds us that even large reserves can drain quickly in a true panic. Second, the exchange rate system. Back then, Korea effectively maintained a fixed exchange rate. When pressure built up, the collapse came all at once. Now, under a floating system, adjustments are gradual, but volatility is ever present and keeps investors on edge. Third, the financial structure. In 1997, companies and banks depended heavily on short-term foreign loans. When foreign investors pulled out, insolvency spread instantly. Today, the system is more diversified, through long-term bonds, stricter regulations, and currency swap networks. Yet in some emerging markets, reliance on short-term capital still leaves them dangerously exposed. Fourth, the lingering risks. A strong dollar driven by U.S. interest rates continues to pressure vulnerable economies. Argentina has stumbled into default time and again, while the Turkish lira has lost over 90% of its value in the past decade. So what can we conclude? A crisis identical to 1997 is unlikely. But the same weak points, dollar dependence, capital flight, and external shocks, remain alive and dangerous. Crises don't repeat in the same form. They return with new faces. The lesson from 1997 is clear. Only nations that prepare in advance can transform crisis into opportunity. And that's the message emerging markets must hold on to today.